Hi, I'm Patu from freefincal. Today, let's take a look at Benjamin Graham's 50% equity, 50% fixed income or bonds strategy, whether it will work for the Indian scenario. If you ask the typical advisor, they will tell you, equity loving advisor, they will tell you that for a long term goal, you should have 60%, 70%, 80% equity, and you should hold that equity for a long time and so on. Um, let's take a look at this conservative strategy, supposedly conservative strategy, explained by Benjamin Graham in The Intelligent Investor, where he talks about this kind of strategy as suitable for as for an average investor who does not have much of a time to analyze stocks, analyze the market conditions, and so on. And Swapnil Kande had written a very nice post about this, explaining Ben Graham's reasoning and so on. I've linked it in this article. You can have a look at that. So we're gonna do this back testing pretty much similar to what we did with the S&P 500 plus Sensex combined analysis. The same machinery we're going to use, and I want to first of all point out that when you are mixing two asset classes, that is, we are mixing equity and fixed income. When you're mixing these two, there's no optimal combination that you can think of. It just becomes personal, preference. In the sense, this is like, for example, like mixing paint. If you mix red color with white color, from red you can go all the way to complete white. As you mix more and more white, you in the middle you'll get a series of pink shades. Which pink you use is up to you. So you can't ask for a optimal combination. When you are having multiple asset classes, 3 or 4, then you can think of some kind of optimal combination based on backtesting. We will talk about that down the line. Alright, so the second point is that we are talking about a generic long-term portfolio without any goal in mind. When I have a financial goal in mind, then I have to talk about how to change the asset allocation down the line as I have a target and so on. That part we are not going to talk about in this video. The third point is that data is only available from September 1996. The markets are constantly changing, so we have to look at it. Look at this 50-50 portfolio on an absolute measure, not say which is better, 70-30 is better, 60-40 is better, and so on. I don't want to get into such arguments. That makes no sense. So this is the full data. The ISEC sovereign bond long-term gilt is shown in red. The Sensex is shown in blue. You must have seen this a couple of videos ago. And now, if you do a first run, that is a 10-year investment between September 1996 to September 2006, you will get the value. The value will increase like that. That's how the first run will look like. The XIRR of the 100% Sensex portfolio will be 22.4%. The XIRR of the 50-50 portfolio is 18%. Already that's very, very good. Even at 50% equity, there's only a 4% drop in return, which is awesome. And the beta of the portfolio, that is the relative volatility, is 84%. This means that the 50-50 portfolio has a 16% lower volatility than the 100% portfolio, and as we will see below, this 16% is pretty much guaranteed. So we are going to run this over 165 10-year runs from September 1996 to April 2020. All the 165 data points, the return difference between Sensex only portfolio return minus return of the 50-50 portfolio, that's the return difference that's plotted here. That's the blue dots. The orange dots is the beta that you see on the right side. The beta is more or less around 83% or so. The average is something like 83%, so 17% lower risk. If you plot the return difference versus the Sensex, whenever the Sensex fell down, the 50-50 portfolio gave more returns. It actually bet the Sensex only return naturally, and it actually outshone. And currently, when the Sensex is nicely down, you can see that the 50-50 portfolio has done better. And these are the absolute returns that you see. The pink dots is the Sensex only return. The blue dots, the 50-50 portfolio return. These are the absolute returns. And if you choose 60-40 or 70-30 equity, the gap between the pink dots and the blue dots will change, but that's not something that's of much importance. The point I want to make is on an absolute level, the 50-50 portfolio has given 10% less than 10%, less than double digit returns only 4 out of 165 times in the past between 1996 and 2020, which is an awesome statistic. So Ben Graham's idea works like a charm. Of course, you should know. So my point is that this is the true benefit of diversification. You get guaranteed lower returns, sorry, you get guaranteed lower risk, but the returns are typically lower than 100% equity, but they're not so low. They're not that you don't. I mean that you'll be disappointed. So this is a good balance between, that is, nobody can have 100% equity portfolio, that's too risky. Nobody can have 100% bond portfolio, that is also too risky, because you can't beat inflation, and the amount you have to invest for beating inflation will be too high. So your good balance is 50-50, where you can balance the risk as well as the amount you need to invest for your goal in order to beat inflation. So this is a very good balance in my opinion. And uh, uh, I mean, this can be used for anybody, not just conservative investors. That's the whole point. This is not a conservative portfolio. It's an efficient, effective portfolio that can be used for that can be used by anybody. Now we're going to use this machinery and add gold into it and see what happens. We're going to change different things and see what happens into in future posts and so on. Let's see how things go. So I'll catch you later. Bye bye.